Hello everybody, and welcome back. If you're following along, this will be part 2 to understanding our key economic concepts. We dove into what is money. Let's check out some important concepts surrounding money, like bank solvency, money multipliers, the first and second banks of the United States, and more. These key ideas are crucial for understanding how the financial system in America works. All of these are review from the lecture on Tuesday, which was October 15th. So without further ado, let's get started. Banking, solvency, and assets. A bank's primary liabilities are things like deposits. These are short-term and can be withdrawn anytime. And banknotes. These are important because they represent the money the bank owes. But a bank also has assets, which generate profits. These assets include loans and bonds, or as he calls them, securities. These are what the bank invests in to earn money. But be careful, when interest rate rises, the value of the bonds typically decrease, which lowers their overall market value. To determine if a bank is solvent, we calculate its capital by subtracting its liabilities from its assets. If the result is positive, the bank is solvent, and if not, the bank is in trouble. A key measure of bank profitability is return on equity, or ROE, and that is calculated by dividing a bank's profits by its capital. And the formula for that is displayed here. Another measure is return on assets, or ROA, which tells us how effective a bank is using its assets to generate profits. And that formula will be return on assets equals profits over assets. Simple. And leverage is also important. It's a measure of how much the bank relies on borrowed funds to support its assets. And that is shown by leverage equals assets over capital. But increasing leverage can increase the risk of insolvency. If a bank's assets drop in value, the bank could become insolvent very quickly, so we have to be careful. So while leverage can magnify your profits, it also increases your risk. To boost ROE, a bank can make riskier loans or buy riskier securities, but these typically offer higher interest rates, but they also come with a higher risk of default. Another way to increase ROE is through leverage. Leverage magnifies profits by allowing a bank to control more assets with less capital, but as we mentioned before, this also increases the risk of insolvency. Let's move on to the money multiplier, which is a key role in how banks create their money. And that formula for money multiplier goes as this. Money equals the high-powered money times 1 over the currency ratio plus the reserve ratio minus both of them multiplied. When interest rates rise, the money multiplier tends to decrease because banks lend less. When interest rates fall, the multiplier increases, encouraging more lending and deposit creation. During a bank run, people prefer holding currency over deposits, causing the money multiplier to shrink. This can severely restrict the amount of money available in the economy. He also mentions the financial crises and shadow banking. A major risk for financial institutions, especially shadow banks, is when they finance long-term assets with short-term liabilities. And you may be asking, what is shadow banking? It's when financial activities act like regular banks, but aren't regulated the same way. Shadow banks don't take deposits from customers, but they do lend money and invest in real things like real estate or stocks. Examples of shadow banks include hedge funds, investment funds, and other companies that give out loans or make investments. And the problem with that is that the investor is at risk when they borrow short-term money to invest in long-term projects if they can't pay back their short-term loans or borrow more money. They may run out of cash, and that's even if they have a valuable long-term asset, and it can cause a big financial problem. And so, in relation to the 2008 financial crisis, shadow banks were borrowing short-term money to invest in long-term riskier things like home mortgages. When the housing market collapsed, and the home values dropped, these shadow banks couldn't borrow more money or pay back their loans. And this led to the liquidity crisis. They didn't have enough cash to keep going, and many shadow banks became bankrupt, causing big problems for the economy. In short, shadow banks play a big role. Let's look at the first bank of the United States. The first bank of the United States was chartered in 1791 for a period of about 20 years, with 20% of its capital owned by the federal government. It acted as the government's fiscal agent, handling deposits and payments. Importantly, the bank helped regulate state-chartered banks by holding their notes in gold and silver, assuring stability in the system. However, the first bank wasn't rechartered in 1811 due to opposition from the Anti-Federalists and state banks. They saw it as too powerful. So after that, we had the second Bank of the United States, which was chartered in 1816, about 5 years later, with this same structure. 22% of its capital was owned by the government. It could continue the regulatory work of the first bank, holding state banknotes and redeeming them, which helped them stabilize the financial system. The second Bank of the United States was essentially designed to pick up where the first bank left off. Like the first bank, it was responsible for handling the government's money, making payments, and managing our debt, which grows ever so exponential each day. It also acted to regulate state banks, ensuring that they didn't issue too many banknotes. The second bank also played a key note in stabilizing by holding state banknotes and redeeming them for gold and silver, helping to control inflation by limiting how much money state banks could actually create. However, the second bank also faced a lot of opposition, just like the first one. Many people, especially those who supported state banks and believed in state rights, thought the federal bank had way too much power. This opposition came from our president, Andrew Jackson, at the time. Jackson, who disliked the idea of a powerful federal bank, refused to renew the second bank's charter, and in 1836, the second bank was closed down. And after the closure of the second bank, the U.S. economy experienced periods of instability, with no strong central bank to regulate our money or oversees the banking system until the creation of the Federal Reserve, which was in 1913. So with all of that being said, the lessons that we've learned from these institutions remind us that a well-regulated banking system is crucial, not just for the banks, but for our entire economy, because they affect everything from the value of our money to our ability to borrow and invest. Thank you guys for sticking with me in this deep dive of U.S. financial history. I hope it helped you. And as always, I hope you guys are enjoying these videos that I'm creating for you. I'm glad that the Patreon is very useful for you guys. If you have any suggestions, or if there's anything that you're struggling on or would like me to make a video about, please don't hesitate to reach out to me, and have a great day.